And I would like to talk about Chapter 6, Inventory Cost of Goods Sold. Inventory, of course, is an asset that represents tangible property. Tangible means you can physically touch it. It has a physical substance that is held for resale in normal course of business. That is, that's what these are things that you sell with, or used to produce goods or services for sale. In other words, or represents inputs into goods or services that you produce. So, for a regular manufacturing company, it might be things that they actually sell, the finished products, or the material and other components that go into these finished products. For the retail company, for retail reseller or wholesaler, it could be the products it sells and so on. In general, like any other asset, inventory abides by this equation here, which is the beginning balance plus purchases, which is that's presumably it's a reseller of some sort, minus cost of goods sold. This first component, beginning inventory plus purchases, is called cost of goods available for sale. You can, in particular for a manufacturing company, you can think about three types of inventory, three components of inventory. The one that we tend to think about are the finished goods, the finished product, but then you can think about the inputs, right, and raw materials, right? So if you produce furniture, those would be the wood, the paint, and so on. Work in progress, which is the intermediate stage inventory, which is not entirely complete, but is being produced, but in other words, it's no longer just raw material, but it's kind of this intermediate stage. The key thing to remember about inventory, and for that matter for most assets, is it abides by capitalization principle. Capitalization principle has to do with what do you consider an asset, what expenditure you consider an asset. So any expenditure that has long-term benefit and is necessary to make the asset available to the company needs to be capitalized. It needs to be included in the cost of the asset. So all costs incurred to make inventory ready for use have to be included in costs of inventory. For example, freight. If you have to transport inventory to the warehouse to make it available for sale, the cost of transportation of the freight of inventory has to be included into inventory cost. So types of costs to be included in inventory balance, for example, materials, direct labor, right, which is the cost of salaries you pay workers to produce inventory, is included in the cost of inventory because that cost is incurred in order to produce inventory, so you have to capitalize it. Any overhead are the indirect costs associated with production of inventory. So for example, you have to allocate costs of the warehouse associated with the warehouse in which inventory is stored to the actual units produced. This is something that you learn in management accounting and the cost accounting. But you still, because you wouldn't have the warehouse had it not been for inventory, you need to absorb cost of the warehouse in the cost of inventory production. We already talked about transportation, freight in, right? Costs in particular for FOB shipping point companies with the title passes for the goods that are bought in transit passes to the buyer. The freight in is capitalized. Cost of warehousing. So in general, any costs that are incurred to make inventory available for sale are to be included. We already talked in the previous chapter a little bit about inventory ownership in transit. We talk about two types of contracts or transportation contracts, if you will, FOB destination and FOB shipping point. An FOB destination contract titled for the inventory passes from the seller to the buyer upon delivery. So that means in transit, the goods are owned by the seller. So freight costs are not capitalized by the buyer because the buyer doesn't pay them. FOB shipping point, as already mentioned, the goods are owned by the buyer of the inventory, and so therefore they capitalize the cost of transportation, the freight in. So when do you estimate cost of goods sold? Traditionally, there are two ways of doing it. One is the so-called perpetual system. The other one is periodic system. Perpetual system of inventory, of cost of goods sold calculation, means that cost of sales is calculated every time the item is sold. So anytime you go to Walmart, buy something, and Walmart, as you leave the cash register, when your goods are scanned, it's taken off the inventory ledger. And that's pretty much most companies do it that way today. Computer systems allow for virtual immediate tracking of all sales. But it didn't used to be like that all the time. Before the computer time, people might have been too cumbersome to do that. So essentially, you only tracked your purchases, and you calculated cost of goods sold only in the end of the period through the inventory count. So in other words, you knew what you started with, which is the cost of goods available for sale. You know what you ended with, which is cost of goods sold, which is the ending inventory count, whatever you counted, and you took the difference as being sold. And that's called periodic system. So in a periodic system, you have basically cost of goods sold is simply beginning inventory plus purchases minus the ending inventory. And what it implies is that you know this part of the equation at any point in time, but in the end of the period, you count the ending inventory and you compute the cost of sales. So you don't know cost of sales until the end of the period. But under the periodic system, it's not a problem because you know, on the perpetual system, it's not a problem because you know what the purchases in the beginning are, you know exactly what you sold, so you can calculate ending inventory without the count. It's just available in the computer at any point in time. So then the question arises, so suppose you have, you have a bunch of widgets. You start with 20 widgets that are purchased at $10, you buy 100 widgets at $10, buy another 200 widgets at $11, buy another 50 widgets at $9, and then you don't track what you sell necessarily. Suppose you went there and at the end of the period counted you have 40 widgets left. So the question is, presumably all these widgets are identical, but they were all purchased at different prices at different time. So how do you calculate the cost of goods sold? What widgets do you think, at what price, regional acquisition prices do you have left? Well, you can track it exactly, but it might be too cumbersome. So I'll get to that in a minute. So what are the cost of goods available for sale? Well, that's just the beginning inventory, in this case, plus all the purchases. It will give you here cost of goods available for sale, which is $38.50. You started with 20 widgets, you purchased 350 widgets altogether, and you have 40 widgets left. That means that 370, which is number of widgets available for sale, which is 350 plus 20, that means you sold 330 widgets. But the question is, which one of those widgets are those widgets? Is it these widgets? Is it these widgets? Or is it these widgets? We don't know. So this is why you need what's called assumptions about flow of inventory, cost flow of inventory. So we have several ways of calculating inventory assumptions. There's something called LIFO, FIFO, and weighted average, or specific identification. So specific identification is when you actually track which, somehow you mark your units, you know exactly which units were sold, and you can track back to the original purchase date. Now that might be feasible for some highly valuable items you don't have a lot of, maybe you're selling diamonds or something. Okay, because they're very unique. But in a practical warehouse situation, it's too costly. Now, if you did the specific identification, so you know exactly which one unit you sold, then it's, you just add up the cost of those units. In this case, I gave you an example, and you know that you know exactly 90 units at 10, 210 at 11, 30 you bought at 9. So then you calculate cost of sales precisely, and then you know what your inventory balance is, ending inventory balances, which is the cost of goods available for sale minus specifically identified cost of sales. Now, practically, it's too cumbersome to do for most manufacturing companies because you don't want, especially if it's a low-cost items, why would you track exactly which units were sold when? So you follow what's called inventory flow assumptions, which is LIFO, FIFO, or LIFO, or weighted average. FIFO stands for first in, first out. LIFO stands for last in, first out. The weighted average will take the average cost. What does it mean first in, first out? It means that you assume that whichever unit was bought first, it gets sold first. And LIFO is the other way around. Whatever unit was bought last gets sold first. So I actually created a little spreadsheet just to show how it's done. So these are my all of my purchases. This is my beginning balance here. These are all of my purchases. I have 370 units available for sale, which is the sum of all of my beginning balance plus the purchased goods. I know exactly what the value of that is. That I just price times quantity added up. So it's 38.50. Now I can calculate the average cost right away, by the way. I'll just take the total value and divide by the number of units. That's $10.41. So now I have 40 units left. So what are those 40 units? So under first in, first out, we assume that whatever units were bought first are sold first. So whatever is left should have come from the latest purchase. So in this particular case, there's only 40 units left. So it must have come from this last purchase of 50 units. So under FIFO, you can see my formula, it's just 40 units times $9. Times $9 must have come from this layer under FIFO. Well, if I know now that I only have $360 left on hand, then the cost of goods sold is simply the difference between, in this case, cost of goods available for sale, $38.50, minus my ending inventory, or $34.90, right? Under LIFO, it's the other way around. So which 40 units are those? Last in, first out. So whatever is the last units left, the earliest units purchased or available, we'll assume are the ones left in the inventory. So I'm going to assume then there's a $20 at 10, and another, 20 units at 10, and another remaining 20 units, another 10. So that works out to be $400, and you see the formula captures that. So if my ending inventory is 400, that must be that my cost of goods sold is the difference between cost of goods available for sale is $38.50 minus what's left is $400. Now, average cost is easy. There's a reason why I calculated the average cost. The average cost here is really the weighted average, kind of, right? You took prices times quantities and divided by quantity, sort of like what you'd divided total quantity, sort of like how you'd calculate a GPA. Well, it happens to be that if you know what the average cost is, then you simply just take the average cost, and to calculate ending inventory, which is 1041, you take the average cost multiplied by the number of units left, which is 40, and that works out to be $416. And then the weighted average cost of goods sold is just the difference between units available for sale minus the cost of goods sold, minus the ending inventory. So that's pretty much how it's calculated. There could be some complications, but for our purposes, that's enough. So that's what the next several slides basically do. Now, why you would choose LIFO versus FIFO? Well, remember that under LIFO, because it's last in, first out, tends to be that because of inflation, units that are bought later, they tend to be more expensive. So therefore, cost of goods sold in the inflationary period, on the average, will tend to be higher for LIFO than for FIFO. So cost of goods sold will be higher. So that means profits will be lower and your taxes will be lower because purchases are the same in the LIFO versus FIFO. We just saw in my example here. Right? Purchases are all the same. Those are the same, right? So if you look at my example, you can see that certainly under it's interesting that under FIFO, my cost of goods sold in this particular case was was lower, and that's because my FIFO cost of goods sold was higher. The LIFO was lower. Why? Because in fact, in my example, the later purchases were less expensive, right? So I have deflation rather than inflation. But if I actually had inflation instead of $9, here I had $13. Say, for example, suddenly my numbers change, and you can see that LIFO cost of goods sold, in fact, is higher, $36.50 rather than $35.30, and substantially so, which is more often the case. And so for that reason, LIFO is preferred by companies who like to minimize their taxes. And that's because if you use under what's called LIFO conformity rule by the IRS, you have to follow LIFO for both tax and financial reporting purposes. But that is only two, by the way, as we saw in my little Excel example, that LIFO cost of goods sold is higher, so long as one of the two things happen. One is that there is inflation, right? So here I have kind of deflation. My last purchase is actually lower in price. So let's make it $13. So in this case, if my last purchase is 13, so my prices go up over time. In fact, LIFO COGS here is higher than FIFO COGS. Now, there is a secondary condition, and that the secondary condition is that the company buys more units than it sells. In other words, there's always, so it doesn't go back in time. It doesn't go back to earlier layers of LIFO. In this example, we won't see it because we don't have sales. All of our sales kind of are assumed to happen afterwards, or this is on the periodic system, but we can't really see that. But under LIFO, if your company starts selling more units than it buys, in fact, the pattern will reverse. The pattern, the cost of goods sold under LIFO will be lower than under FIFO, and your profits will be higher. Now, why is this? This is called deepening into the LIFO layers or LIFO liquidation. And the reason why this is kind of the dark side is because even though you are essentially buying less than you're selling, and you usually would do that if your company is not doing so well, if you think that your future prospects are not so great, your profits mechanically will be higher. So LIFO will result in this kind of distortionary effect. So in the period of rising prices, inflation, as long as unit purchases exceed unit sales, LIFO COGS is higher than FIFO COGS, and LIFO in inventory is lower than FIFO in inventory. LIFO companies are required to report what's called LIFO reserve, which in their footnotes, which is if you follow LIFO, you have to report the difference from FIFO, what FIFO inventory would have been, right? So you have to essentially keep a second set of books and track somewhere what your FIFO numbers are, and then report them in the footnote. That's called LIFO reserve. The difference between the LIFO inventory, between the FIFO inventory and LIFO inventory. FIFO inventory is always higher than LIFO inventory typically. And so that number is positive, and that's called LIFO reserve. And you have to report it in the footnotes. And the reason why this is done is to allow conversion for anybody who wants to convert LIFO numbers to FIFO numbers, that you can do that. And that's what we do in the financial statement analysis class. I teach you how to do that. That's the opposite is not true for FIFO companies. FIFO companies are not required to report, the difference from LIFO because, people generally FIFO is more common and considered it doesn't have the dark side that I described. Weighted average method, we talked about it. It's just basically kind of like calculating your GPA. So you take total value or total cost of goods available for sale divided by the number of units available for sale. That's the average cost, and you just multiply by the number of units remaining to get the ending inventory and the number of units sold to get the cost of sales, which is what I did in my example. So this is about calculation of cost of goods sold and assumptions going into cost of goods sold. On the balance sheet, inventory needs to be carried and what's called lower of cost or market. In other words, lower of two numbers, either at cost, meaning whatever you acquired it at, or market. That means that if the inventory value substantially decreases over time and you can't sell it, you need to write it down to the market value. So for instance, I give here in 2001, Cisco had to record $2.25 billion in inventory write-off for the bad routers, internet routers nobody wanted to buy. And that's because the inventory value is a significant predictor of performance. We don't want to be overvalued on the balance sheet. So what does it mean on market? Market is a net realizable value, which is the market value minus reasonable market price, if you can get it, minus direct costs of selling it, minus selling expenses. And if you have to write down to the net real inventory value from whatever its historical cost was, the acquisition price, to the market value, you have to recognize a loss in earnings and net income for in inventory write-down. And the account, either you can do it directly by credit in inventory or have a separate counter asset account called inventory obsolescence reserve, and so on. So MVP has 200 units of inventory, originally recorded at $10 per unit, which is $2,000 in the balance sheet. Now the value goes down, the net realizable value $5 per unit. So its total value is $1,000. So you need to reduce the balance sheet value from 2,000 to 1,000. So you recognize that you can recognize a loss. You can simply charge it to cost of goods sold, and so you debit cost of goods sold in this example, credit inventory or an obsolescence reserve, $1,000. The key inventory metric to evaluate the value of the inventory is inventory turnover ratio. Inventory turnover ratio is the ratio of cost of goods sold to the average inventory balance. And if that ratio suddenly goes down over time, it's a signal that there may be a problem with the inventory, that it's overvalued. So if inventory turns suddenly decrease without explanation, research shows that it's a predictor of the fact that essentially a signal that inventory is overvalued. The final point I'd like to make is that, going back to our discussion of perpetual versus periodic system, today pretty much everybody uses perpetual inventory system because the computer systems allow you to essentially instantaneously track all sales and you know exactly what gets taken off the rolls. However, as a control method, companies still do periodic inventory counts, which come to us from the periodic system, and as just a way to true up the final inventory balance in the end of the period. And so that concludes my discussion of inventory. Thanks very much for listening.